This is American Dreams, a program where we interview thought leaders and entrepreneurs and bring their ideas to you in real world context. Welcome to today's show. I'm visiting here today with Randy Barron. Randy, welcome.
Thank you, Alan. I'm glad to be here.
So, Randy, for the investors, you have a remarkable background and set of accomplishments as a portfolio manager, but can you take us up on your timeline and what brought you to where you are today?
Well, I don't know how deep you want to go. My very first job was as King Kong in the Empire State Building, which not many people know. But yeah, for 25 years, I've been a stock picker, which is what I do. And now I run an international kind of best ideas all over the globe portfolio for a firm called Pinnacle Associates. So Pinnacle Associates was founded in 1984. We are all employee owned with no debt and a real history of small mid-cap picking. So we're kind of looking for best ideas anywhere in the world under $5 billion. And, you know, what's really interesting about our approach is that we're stock pickers. We don't do shorting. We don't do derivatives. We don't do leverage. It is plain vanilla. And so the things that become our North Star are things like quality of management, for example. And so my background, about 2.5 decades ago, I started after kind of the traditional JP Morgan everything route with a stock picker named Mario Gabelli, and kind of came from that school where we really did kind of Graham Dodd, Buffett style approach. And I was a telecom and media analyst, kind of just sourcing cash flows and looking for all of that. And then about 5 or 7 years ago, I came to the realization, and you're very kind to point out the performance kind of followed with that disruption and kind of new form platforms have a real space. So if you take that traditional value paradigm and shift it onto growth at a reasonable price, you could find some really, really interesting and transformative ideas. And that's kind of been the arc of the narrative.
You know, not everyone gets to that number one position. How would you characterize your approach versus how others approach things when you're trying to identify disruptive technology and value-driven inside stocks?
I'm reminded of the Churchill quote, you know, never give up, never give up, never give up type thing. And that's the truth. The work is the time that goes into it. And we're fortunate because of our investor base that the arc of time that we look at is at least 3 to 5 years. But someone once gave me a great definition of infinity. They said infinity is a place that's so far away, if it were any farther, it wouldn't really matter. Which is to say, I'm graded monthly, I'm graded quarterly, absolutely. But if the arc of time that you're approaching a prospective investment in, there's one that I'm sure we'll talk about, Amyris, that I literally think of in a 20 to 30 year time frame. And so, you know, how do we find those ideas is we do a lot of truffle hounding. Our nose is in the dirt, we're digging it out, and we do a lot of time. And the way that I prefer to invest is if I find a management team and a concept that intrigues me, I'll do some work on it and I'll put a little bit of money in. And then over time, quarters, years, we'll find out, are you the type of management or the type of person really that can deliver on what you're setting out with goals and expectations and all of this. So we have for example, we were the first US investor in a UK listed stock called Renalytix. The stock is up probably 5 or 6 times in the last 2.5 years. And everyone always comes, they say, Alan, you know, you're a great stock picker. This thing is up. But they don't realize that our average cost basis is probably only up 2 to 2.5, because again, it just seems from a fiduciary perspective, if you put a little in, they do well. You put a little more, they do well. Like that to me seems prudent. And, you know, we're not in the same foxhole. So how do I tell if you can handle the stress, if you can deliver, if COVID-19 happens, that you can still execute? And one of the kind of feathers in my own cap that I'm really happy with is that if I look at the portfolio in December of 19, so pre-COVID to today, it's 80 to 85% the same names. mean, we didn't run or fly. We had these relationships with managements. We had the arc of time. We understood what they were doing. And that allows, from a management perspective, they love shareholders like that because I'm not lending out my shares to short. I'm not calling you with red letter words unless you do something really dumb. Maybe we're going to check in once a month or once a quarter to have a dialogue. But I want to leave you to run the business. And that's kind of how we've been able to frame that out a little bit.
For the investors coming in, which are typically high net worth individuals and family offices, what time frame do you ask of? In other words, you don't want someone popping in and out of your fund. You want to have some time given. So typically, what are the terms by which you'll accept the money? Is there a minimum that comes in, and then what do you ask from them?
No, it's the right question. And in fact, when we were structuring and then restructuring and thinking about the best way to do it, early on in that process, I made a decision that I would never put my own capital into something with a lockup. It just doesn't feel right to me. I know from the financial architecture perspective why you would want to lock up. It makes sense. But again, we're not dealing in distressed assets or things that are illiquid or things that I'm going to need 3 months to get out of. So for us, we have monthly liquidity, which I think is a real boon. And, for us, it's a conversation. So for example, Alan, let's say you're a high net worth guy, you and I sit down and talk. It's not certain that we're the right fit, right? And so it's not as much about saying, all right, you need to commit for 2 years. No, it's, do you understand what we're doing here? Do you respond to it almost on a visceral level, such that when there are the vicissitudes of Mr. Market a la COVID-19, I didn't get one call for redemption in that time frame. And I think that speaks to the investor base understanding what we're looking for. And by the way, I should also stress, because it's small mid cap, the things that we're owning are not Verizon or Comcast or these behemoths where the Goldman Sachs analyst is going to have a team of 12 people that will always be able to do channel checks and door checks and know it better than, me and my little team of 3 people will be able to. We want to be on the other side of it to find those smaller companies that are, call it 200, 500 million, $1 billion at the start, and are going to grow to 5 or 10 or 20 billion, which we've been lucky to find some of those. And I think our investors appreciate that that's a differentiated process, and therefore they're willing to tolerate some volatility. I mean, we concentrate in our top ideas, so by definition, we're volatile, but we define risk, which we're always mitigating, as the chance of permanent capital loss. So in other words, if we say, you know what, even though this stock is priced for an event, like a Chapter 11 event, we think the market's wrong for a whole host of reasons. And then we're willing to wait it out and kind of see it through. And our investors understand that.
Is there a certain percentage of the portfolio that's allocated into venture capital? Or in recent years, we've had these special purpose acquisition corporations or SPACs come in?
So we are all public equity. So that's the first thing I would say. There's nothing, there's no private equity. There's no mezzanine financing. It's again, what I said at the outset, it's kind of boring. My wife always laughs at like plain vanilla stock picking. That's what this is. But what we do sometimes, because we have these relationships with managements, is we'll be invited to participate in a PIPE or a private investment in a public equity. And the PIPEs that we do are, there's a public equity already out there. We know the management. They want us to participate. They'll come and say, hey, listen, will you and your investors be willing to come and to give some money at a discount to the public price in something that there's no lockup on that trades immediately, just so we can have you even more embedded in our shareholder base. The funny thing on SPACs, and by the way, in my career, this is the 3rd or 4th iteration of the blank check company. It's always called something different. I always laugh because they can give projections. You know this phrase, anyone can make a PowerPoint? There's no SEC regulation. There's no prospectus that you need to go and vet. So it's like, I can kind of paint some things and some pictures, and there's no real accountability to it. What I do find interesting of late is that some of the SPACs have had the PIPE portion of that not funding, and that's kind of been a newer trend that's happening. But again, we're not going to get caught up in any of those shenanigans, if you will, and we're looking for really solid, defensible, things where I can pull up a 10Q or a 10K and I can say, hey, this is how you're reporting. Let's drill through it. And by the way, that also speaks to why, despite the fact that we're global managers, another thing that your listeners should be aware of is that we're very underweight Asia. So Japan is 34% of the global small cap benchmark. That's a legacy of the 80s when Japan was kind of the thriving economy that it was at the time. And, we spent a lot of time trying to get in touch with Japanese companies, to visit with Japanese managements, because again, that's our North Star. Well, we hired analysts that would read Japanese. And at the end of the day, what we realized is we couldn't access the financials in a defensible way. In other words, I couldn't look at the source data and say, okay, this is what cash flow is, right? We couldn't get access to management in a way that would make us comfortable. And so over time, I mentioned Churchill before, we've kind of evolved to what he would call the Commonwealth countries, where a lot of the places that we invest today are Canada, South Africa, the UK, Australia, places that share a cultural norm, share language. And that's ended up proving to be really prescient because, and here's kind of the end of the arc, there are today a lot of US-based managements, US-based companies that are opting to access the capital markets, for example, in the United Kingdom. They may be too small to do a NASDAQ listing, but they're not too small to do a AIM, which is the London secondary market listing. And the thing I like about the fact that these US managements are doing that is when you list in the UK, no leverage allowed. Think about that. In the US, you could have something levered 3 to 5 times easily at IPO. Here, these companies had to have net cash. So if and when, gravity affects everything, when the market comes down, I'd rather be in the stock that has a net cash balance sheet than the thing that's levered 3 to 5 times, just all else equal. But I also like the fact that when you look at, just to continue the UK example, the FTSE versus the S&P, they're very different indexes, right? So the FANG heavy S&P, people are always shocked. We talk about the FTSE, 2% of the FTSE, which is the UK market, is tech. 2%. Think about that versus 30+% in the US. And therefore, when you look at the divergence of performance, it's the reason that we're finding all these opportunities abroad because the tech-led US recovery from COVID disruption was amazing. Zoom existed before, but no one really used it. That kind of disruption exists a lot of other places in the world, but they have not gotten the valuation re-rating outside of the US. So I'm buying comparable companies that you'd find in the US, comparable managements for maybe 4 to 5 multiple points cheaper. That is jaw-dropping. And then over time, when you ask about how do these returns work, over time, that there's a great country song where you start your fence post, I'll start mine, and we'll meet in the middle.
You're very hands-on with these the CEOs and managers, and how many companies do you prefer to work with inside of a fund?
So a couple of things. I'm going to approach it from the investor perspective and then the company, because one of the things that we also do from an investor point of view is we do a lot of separately managed accounts. So an investor come to us with as little as $250,000 or $300,000, but specific needs. For example, socially responsible investing is so the topic du jour. But not everyone, if you look at the classic ESG, not everyone looks at environment and social and governance the same. You may care a ton about water safety, right? I may care about gender diversity in the board. So we can kind of really cater specifically to people. Obviously, the funds themselves have a higher threshold to come into. Our concentrated approach yields about 40 positions in a fully diversified strategy. The reason we did that is when we did a traditional kind of bell curve, 70 to 80 names, we realized what was hurting performance at that time was the tail. In other words, it wasn't position 1 or 2 or 3. It was position 65, 70, 72 that were dragging down in combination cumulatively. And so for us, we really like to be high conviction investors. And so therefore our top 10 ideas could be, 60 to 70% of a portfolio in aggregate. That's very concentrated.
average size of investment going in is what?
Average size, probably about 3.5% of the portfolio going in. However, some of these names I've mentioned, like Renalytix and Amyris, those are 10% positions. And certain clients call us and say, hey, we've heard, and by the way, and not to link to other, but if you type Randy Barron Amyris, there's a great podcast that I did that for an hour and a half shows how the sausage is made in stock picking. And there are people that come to us knowing our knowledge of it and say, hey, listen, we think Amyris is Amazon in 1993. We want that to be 15%, 20 client directed, in which case we'll go higher. We don't have a ceiling above which we won't go. Our ceilings are more on the opposite side, which is we don't really do emerging markets for the same reason I kind of talked about Japan. I remember looking at I mentioned at the outset, I was a telecom guy, and I used to look at Argentine telecoms, and I was so impressed because you could buy these things for 2 times cash flow, right? And in the US, if you could buy a telephone company for 2 times cash flow, you don't even go look at it. You just buy it, right? You go. Well, here's the kind of philosophical question. If you're buying it at 2 times cash flow, but the Argentine peso is devaluing at 80 to 100% a year, what are you really paying in real terms? And by the way, that's a trick question. There's no answer because we don't know where it's going to stop inflating. And so for us, we realized we didn't really need a ton of emerging markets exposure to get kind of that tip of the spear type return. We can find that just by being in disruptive industries. So it's been an interesting ride. Yeah.
So entry fees, if an individual comes and says, hey, Randy, I'd like you to manage an individual portfolio for me. And what is your benchmark or requirement for you to take that on as a client? How much do they need to have?
Well, as I mentioned, in the separately managed accounts, $250,000, $250,000, that's where we start at. Obviously, we go a lot higher than that. You mentioned $7.4 billion as a firm overall. But I don't want to bury the lead. For us, it's about philosophy. If you're someone who likes traditional stock picking in a time-proven way that we kind of have a bottom-up approach that works over time, and you're not going to run for the doors if there's a downturn, then that's kind of a conversation. That's the type of investor that we look for long-term partners in the business. Like if I'm owning a stake in a business, I view that as I'm owning a minority share of a business. I want to therefore be invested with partners who understand that and want to own fractional shares in a business that's going to compound intrinsically over time. The best kind of anecdote I ever got on this was Jeff Bezos didn't become Jeff Bezos by tracking the S&P. So while we do mark to a benchmark, absolutely, it's how we get graded. That's how we get categorized as the top global small cap manager in the world. That's wonderful. Truthfully, that's not really what matters to me. What matters is absolute return, kind of absolute risk mitigation, and the fact that we're going to keep looking for these types of companies in all types of different sectors that can deliver over time.
In today's market, we see a lot about SPACs in the news, and which has piqued the interest of some of the investors. What is your take on it, and how do you approach an investment with the SPAC in mind?
Sure. So obviously at our asset size, we get pitched a lot of SPACs. I do think in many ways, this has been the year of the SPAC. I don't know if that's the Chinese kind of actual year, but it feels like that in many ways. As we said before, SPACs have been around blank check companies have been around for a long time, which is what a SPAC is. It feels in many ways that we are at the tail end, maybe the 6th or 7th or 8th inning of that iteration. This year, of course, we had Shaquille O'Neal and, all these other kind of names, just put their names on something that would then get priced up. What's interesting is that SPACs do allow a path to value. So I mentioned earlier Amyris, AMRS. It's one of our top holdings. We're known for this name. Well, Amyris is in a space called synthetic biology. Fine. Amyris is direct comparable Ginkgo, symbol DNA. It just listed 3 weeks ago. Ginkgo came public via the largest SPAC in history, $17.5 billion. And it's funny, the valuation, by the way, trading today to 140 times revenue, which you kind of roll your eyes and say nothing in this world to trade 140 times revenue, except, and here's the narrative that totally ties in to what I said before about anyone can make a PowerPoint. New York Stock Exchange, symbol DNA given, 3 weeks ago Friday they list, and on the tapestry. I don't know what the word is, but in the front of the stock exchange, they put up the logo and the symbol, and they have a tapestry, for lack of a better term. It's a picture of a Tyrannosaurus Rex saying we can make anything. And I literally turned to someone, I said, if they can make dinosaurs, it's worth 140 times revenue, right? The point is, SPACs allow to capture a zeitgeist, this moment that we can capture a narrative, we can encapsulate it, and we can try and monetize it. I think there will always be ways to access the capital markets. I mentioned UK. For example, no one's picked up on the fact that US companies are increasingly going to the UK because, and I didn't mention this before, there's no quarterly filing requirements. So think about this. If you're a small company, call it $10 million in revenue, right, per year starting out, and you don't have to pay, because you don't have 2 quarterly cycles of filings, lawyer, accountant, audit fees, you're saving about $750,000 to $1 million a year. On 10 million revenue, that ain't nothing, right? And so the point is, you're always going to see the capital markets evolving in a way that they're going to try and eke out value in an efficient way. And I think SPACs serve that purpose. I'm not anti-SPAC. We haven't really done them per se because they're not SEC audited. I can't really go in and check the numbers against something. But the concept of accessing the capital markets, I think, is prudent and works over time.
So, Randy, it's been a pleasure to have you with us today. For people wanting more information on Pinnacle Associates, how would they go about that?
Yeah, they could send an email. My email is rbaron, RBARON, at Pinnacle, Pinnacles, PINNACLE-NY.com.
Been visiting here today with Randy Baron of Pinnacle Associates. Randy, thank you.
Thanks, Alan. Have a great day.